Okay, hello again. This is lesson number 9. What are our reference points? Now, let's talk about a chart, okay? This is a chart, euro-dollar. Just a currency pair. It doesn't matter what time frame, what market, and so on. What you see on the screen, and it doesn't matter how far in the past you watch it. This is all the past, okay? So what you see on the screen is the past. Repeat with me. What I see on the screen is the past, okay? And markets being unpredictable, undeterminate, non-linear, chaotic systems which cannot be predicted, in whatever way you can think of, including chewing in some way, some fancy way, whatever way you can imagine, the past. Okay, so watching the past, calculating the past, using whatever fancy indicators or oscillators you can find, you cannot predict the future of the markets, okay? Because they are not predictable. So when you see the past of a price movement of a certain instrument, you do not know what is the future, okay? Now, here is the past, okay? This is the past. It doesn't matter how in the past it goes. Here, from this point to the right of the screen is the future, okay? On the wall. There on the wall is the future. And you cannot tell in what direction, when, or how the price will go, okay? So the past, whatever fancy oscillator, whatever fancy indicator you choose, will not help you to predict the future, okay? That's very important, because you can waste years trying this and that indicator, and they don't work. When they work, it is by chance, and then they stop working at all. Okay, now as you see, we are using naked charts, absolutely naked charts, no indicators, no oscillators, even no volume. We don't care about volume, because volume and future price movements are as logical and as connected as good news and the price going up, or bad news and the price going down. These things are not correlations that you can base your systems on, or your decisions on. Okay. Now, Така, correlations are not cause and effect connections, okay? So if you have a oscillator or indicator and it correlates with the price at certain time, that doesn't mean that it predicts and it has anything to do with the price. Not lagging some lagging averages, moving averages, they always lag. Everything lags, nothing predicts the market, so we don't need them. They make us very slow. They make us very retarded. We want to react fast. We want to be adequate. Okay? So we don't use any of these. If we have a tree in Africa and a tree in Alaska, they can move in unison, in harmony, in resonance, in positive correlation, or in negative correlation, but they are not connected at all. So that's the case with things you might think that will predict the market, okay? The past and the future of price movements have nothing to do with each other, okay? Nothing to do. That's very important to understand. Okay. Now, when we got rid of difficult and complicated, not working reference points, we are now aiming at simple reference points. The simpler, the better, because our brain power is limited. Even if we use a supercomputer, it does not tell us what the future will be. So we stick to simple reference points, very simple reference points. Now, which are these simple reference points? First, the number of bars. The number of bars, the same color, are like tossing a coin, okay? And this is only the color, not the height, just the color, red or green. Red for the market going down, green for the market going up. So the number of the number of bars with the same color are every 4 bars on average we have 2 with the same color. Every 8 bars on average we have 3 with the same color. Every 16 bars on average we have 4 with the same color. Every 32 bars on average we have 5 with the same color. Okay, we don't know whether this color will be red or green, but it's the same. Okay, it's like tossing a coin for us, for our point of view. So the next, so you understand what I'm talking about. You understand that we are watching the number of the green or the red or whatever bars. Okay, of course, the charts are all the same. All the same. I mean, every instrument must be with the same appearance compared to other instruments. Okay, and always we have the spread. Always the spread. We see the spread. Always the spread. And the same appearance. The same options and the same thickness of the bars, absolutely not one chart like this and the other like this. Okay, the same. So we can see how the character of the movements changes, the character of the market. The next thing, what is the neutral when of the market moves? Well, the neutral is level. This is the neutral. If we open a position and the market is level, we are not losing, we are not making money. If, of course, we close our position the same day, and after, of course, extracting the spread, which is our initial expense on opening a position. So when the market goes level, it's only like this, level or relatively level, it's neutral. Okay, so we use this. No, we use the same color. How often this happens according to probability theory. We use that the market goes level and starts somewhere, and we just wait. If you want a better chart, see this. This is midnight. This is the British pound against the dollar. It goes like this, relatively level, and then it starts somewhere. But there's no guarantee that it will go like this or like this. It might go like this and then start going like this the whole freaking day, okay? So the next reference point, and they're as simple as possible. The time, okay, calendar, you know the calendar of economic reports, the FOREX calendar. Maybe you know it, maybe you don't, but there's a calendar. If you don't know it, check it out. It's free to check. This is an example of this, and you can see that there are previous some values of some indicator, some economical data, and it's the actual, but it can change, like here, so they can change it. This is the forecast, okay, the forecast of the events that news that were not announced yet, okay, like here, and this is the actual. Here in this place is the actual when the time comes. So if they are important, there is important announcement, like unemployment rate for tomorrow, then we must watch for it. We must anticipate it, probably, but it is. We must watch also the forecast. Like this is the previous, this is the forecast. The unemployment rate in the US will go down according to the forecast, and when this forecast is much lower than the previous, previous, then you might expect at least the same direction, okay? same direction. The news, if the news are forecasted to be very, very good, they might be not so good, the actual news, or they might be even better than the forecast, but they will rarely be worse than the previous actual. Okay? But it doesn't matter. The market includes this data in its moves, so you must not base your prediction on this. But we just expect that there will be higher volatility, okay, will be moves here, but it doesn't guarantee us that the moves will not be in the previous session, for example, not the US session at the opening, but during the London session. Okay, so the calendar is one thing, and it is also in correlation. The fundamental analysis has nothing to do with the price moves as technical analysis. Okay, they have nothing to do with that. So fundamental data may be good, and the prices may go down. And whenever you think that this is a manipulation, and every time when the data is good, the prices will go down, no, the market changes, and the news is good, and the prices go up according to the news. So it's only a correlation, and it's chaotic again, and has nothing to do with cause and effect connections. So the next thing, active hours, of course, during the London session. We have more active trades, more active traders. Traders, I mean funds and investment banks, and the market mover. And the spreads are tighter, okay, compared to hours when nothing moves. So sometimes the British pound will move during the Asian session, which is here, in my case, in my time zone. And here is the London session, and then we have the New York, the US session starting about here with Canada maybe, and from here to the right is pre and in the US session. So the Asian session is not is the weakest, let's say it like that. The London session is better, and the US session is the best, because then we have overlapping of the London session and the US session. Okay, so the active trading hours are very important for us. Okay, we trade when the markets are active, and but that doesn't guarantee us that the British pound will not move if there is some event like Brexit or some election results will not move about here, when it's the Asian session, okay? Or the Australian dollar will not move during the US session or during the London session, okay? Impulses, okay. Now the markets, in order for the majority of people to lose money, which is very important for the stable development of the markets, so they they suck in money and not give out money. It's very important for the system. If the system is losing money, it's it's forbidden. It's stained as crime, okay, as terrorism against humanity. So, in order to extract money from your accounts, it is very important that the markets move in impulses. Not always, of course, because chaos is the most important thing, and in chaos everything must have a chance to happen. But impulses, something like that. Markets move. Some people say in steps, not gradually. A gradual movement, of course, happens, but it happens as a private case. Okay, as a private case. There is a market, but most interesting is when the markets start moving fast, and you must wait. You cannot predict neither the direction, nor the timing, nor anything else. You just must wait and get it, and when you see it, you see it. Okay, this is the neutral. The neutral, you make no money and you lose no money, and this is the direction. Do we average down? Well, averaging down is as crazy as waiting when you're losing. Okay, when you're losing and you're waiting, you are actually adding to your loss, because on average, the more you wait, the further away the market will move on average. And even if you want to lose your account even faster, you must just add to your losing positions. You must double up like a martingale system. So then you will totally lose guaranteedly, but in the long run. In the short run, the market might turn and you might make some money several times, 3-4 times in a row, and then you lose everything. Okay, so tight spreads, which appears tight spreads, actives see the same time frame is here, 5-minute chart. Okay, this is from midnight to today. See the euro dollar how behaves, the dollar Swiss franc how behaves, and the British pound dollar how behaves, and the dollar yen how behaves, and the dollar Canadian dollar how behaves. Okay, how of course the most active was dollar, British pound, US dollar. Okay, so we focus on the most active. We cannot predict which currency pair will be the most active tomorrow, but we can see it. We can see it when it happens. Okay. We cannot predict which currency pair in which currency pair the next impulse will happen, but we must focus. We must wait on currency pair, so to see in which currency pair we move. Okay, and if the currency pair has large spreads, wide spreads, and the movements like that, movements like that, and the spread is like that, we don't even care whether there will be a movement or a impulse. We don't care, because with such a spread and such movements, we are working for the broker. Okay. The most important time is after we open a position. Okay, After we open a position, we expect to pinpoint, not to predict, just to be active when the market starts moving. And it is most important that our position starts making money almost immediately. So the most important thing is after we open a position, our position must start making money almost immediately, okay? This is the most important thing. If it doesn't start making money almost immediately, then we are wrong about the active currency pair. We are wrong about the time when we open the position. We must predict, we open here position, and we must be right about the direction of the movement, and we cannot be right many times in a row, because markets cannot be predicted, okay? So, so ordering of the market, when the markets order themselves, means that they do not want to go behind your back like this. If you open a position like this, and let's say this time frame, this is 5 minutes, that just counts the number of bars to here, and this is let's say the big time frame for us from here to here, just for example. And the small time frame is this and this, and the market tries to move behind our back if we are selling, but not so much. So here and here we have rather ordered markets. Okay, so it's a 5 minute chart. Okay, let's see the 1 minute chart. Okay, let's see the 1 minute chart. Okay, so the 5 minute chart and the 5 minute chart, the previous chart, and this one 1 minute chart, you see how the market does not want to go behind your back very far. So even if you open a position like here, you buy, the market does not want to go very far behind your back. So we have different time frames within a bar. Okay, one bar was 5 minutes, and now it's one minute bar. So 5 such bars were in the previous chart 1 bar. Okay, so when it shows when you see a 5 minute bar, okay, we'll go back to a 5 minute bar, we will see that bars have no some big spikes, okay, but are rather normal, okay, rather normal, have no big spikes, which means the lower time frame, the smaller time frame within a 5 minute bar is not going in the opposite direction too far, okay? So the market is rather ordered, okay, in different time frames. It's like, well, let's say the global warming, the earth is warming because there are technologies that can affect the working, the activity of the sun. You can see UFOs, of course, human UFOs, not aliens, they do not exist, that are being dumped in the sun, and the sun changes its activity. Just YouTube search for giant, Earth-like, Earth-sized UFOs near the sun, or something like that, and you'll see it. And we have a global warming, and we also have the summer coming, and we also have a heat wave coming this week, and we also have a very warm night because in the city the concrete is very warm, and of course at 4 a.m. The temperature is the lowest, or at 5 a.m. or at 6 a.m. I don't know, it's the lowest, but still this return of the temperature is not very far, it's not very aggressive. Okay, that is the markets to be ordered, different time frames to be in the same position, and or the charts to be without spikes, the same color, without spikes, but like barrels, okay, without spikes, the same color, same direction. So when you open a position somewhere, it doesn't go behind your back. You don't need to lose money in order to make money. If the market wants to take your money in advance, when you open a position, it goes behind your back, then the market is not ordered. It might give you money back, your money back and profit, but it might not give you back. So you don't take the chance, you don't take the risk. Okay, you don't take the risk. When the market is in such a condition, in such a mode, in such mood, whatever, you just wait and leave it, and you don't go and trade every day, every currency pair, like as if you are going to have, as if you have a 9-to-5 job. Okay, that's impossible to be mechanical when you trade and make money. It's impossible. Okay.